Today, we are going to learn about Sharpe Ratio. A simple yet effective way to compare two or more securities in order to determine which security to invest in. The Sharpe Ratio simply compares risk-adjusted returns of two stocks. Risk-adjusted returns are returns generated against the risk of the security. Commonly used measure of risk or variability is standard deviation. So if a stock is generating 20% returns with a standard deviation of 10% while second stock is generating same 20% returns with 15% standard deviation, a rational investor will select the first stock as it is giving 20% returns with less risk than the second stock. First we need the data for calculation, which can be easily fetched from investing.com. Just log in into investing.com. Search for the company you want to analyze. For now we are analyzing three FMCG companies of India, ITC, HUL and Nestlé. We have selected 3 years of data. We need percentage returns for the calculations of return and risk. We can calculate the returns from the daily prices, but we have already given the percentage changes in the data. So let's combine the data for all three stocks using XLOOKUP so that we get the stock price for the given dates. Just type XLOOKUP, select date, then we need to search the date in this column of HUL, and return the price of HUL for the given date, so we select these ranges. Same ways we also need the percent returns of the stock, so we do the same XLOOKUP for returns. Repeating the process for Nestlé as well. Now that we have the data, we need to calculate return and risk for calculation of Sharpe Ratio. To calculate returns, simply take average of these returns and multiply with 252. You may think, why 252 when there are 365 days in a year? The answer is because there are approximately 252 days, the market is open for a year. So these 252 days cover an entire year. Repeat it for the three stocks. Now comes the risk. In investments, widely used parameter for risk is standard deviation. Now we use standard deviation function, select the range of returns and multiply with root of 252. But why taking root unlike in average? We take the square root because in the variance formula we would have multiplied with 252, and as standard deviation is square root of variance, we take the root here. Now repeat it for rest two stocks. Now we are going to need risk-free rate. We can take the 91 days treasury bonds as the risk-free rate. To calculate Sharpe Ratio, we subtract the risk-free rate from the returns and divide this number by the risk. It is 0.16 for ITC, repeating for the rest two. HUL it's negative and Nestlé it is 0.21. Higher Sharpe Ratio when compared with other security indicate that the stock generated better risk-adjusted returns. Negative sign indicate the stock could not even generate more than the risk-free rate, a return you get without taking any risk. Clearly out of these three stocks, Nestlé is the winner, although none of them have a considerably good Sharpe Ratio.